While you were scrolling through your feed, a financial assassination was executed in broad daylight. The target? The global silver market. The weapon? A single purchase order that doesn't officially exist yet, but has already sent shockwaves through every refinery, vault, and trading desk from Zurich to Shanghai. Here's what they're not telling you. Tesla's supply chain just hit a brick wall. Not the kind of shortage you solve with a phone call to your procurement manager. We're talking about a 50 million ounce deficit, roughly 1,255 metric tons of physical silver that needs to materialize out of thin air in the next 90 days. Or the world's most valuable car company starts missing production deadlines. And here's the part that should terrify anyone holding paper contracts, that silver doesn't exist. Not in the quantities needed, not at the prices currently flashing on your screen. The spot price you're seeing right now, $29.87 on COMEX, is a fabricated mirage. It's the financial equivalent of a storefront with nothing in the warehouse. Paper promises stacked on paper promises, while the physical metal is already spoken for, already locked in vaults from Singapore to Switzerland, and already priced at numbers that would make your broker's algorithm have a seizure. This isn't a supply squeeze, this is a supply extinction event. And if you think the price discovery mechanism is going to function normally when industrial inelasticity collides with a bone-dry physical market, you haven't been paying attention to what happened in nickel, cobalt, or palladium over the last 3 years. The numbers on your screen are lies designed to keep you complacent while the largest wealth transfer in precious metals history unfolds beneath the surface. Let's get into the plumbing, because this is where the real story lives. According to the most recent data from the Silver Institute, global refined silver production in 2024 hit approximately 1.01 billion ounces. Industrial demand, 539 million ounces. Investment demand, 252 million ounces. That's a total demand profile of roughly 1.19 billion ounces against a production ceiling that can't stretch beyond 1.01 billion, even if every mine on Earth runs at maximum capacity. We're already in a structural deficit of 180 million ounces annually. That's before Tesla's procurement crisis enters the equation. Now, add this. Tesla currently uses approximately 2 to 3 ounces of silver per vehicle for electrical contacts, bus bars, and solar integration components. With a production target of 2.5 million vehicles in 2025 and an aggressive push into the Cybertruck and Semi lines, both of which are silver-intensive platforms, the company's annual silver consumption sits around 637 million ounces under normal operations. So, why 50 million ounces? Why now? Because Tesla isn't buying for this quarter. They're buying for survival. They're buying to front-run the export restrictions, the tariffs, and the regulatory guillotine that's about to drop on critical mineral supply chains. They're buying because every other EV manufacturer, solar panel producer, and defense contractor is doing the exact same thing. This is what industrial inelasticity looks like in real time. When you're Tesla, when you've got $95 billion in annual revenue riding on uninterrupted supply chains, you don't negotiate on price. You pay whatever the physical market demands because the alternative is a production halt that costs you $260 million per day. And here's where it gets truly surgical. The paper market, the COMEX futures complex where 99% of silver trading occurs, has exactly 326.4 million ounces in registered inventory as of December 27th. 2024. That's the physical metal available for delivery against futures contracts. Tesla's 50 million ounce order represents 15.3% of the entire COMEX registered stockpile. One company, one order, and that's assuming every single ounce in those vaults is actually available, unencumbered, and not already tied up in prior claims. Which, if you've been following the delivery delays and premium explosions in London and Singapore, you know is absolutely not the case. Notice LBMA 2024-4471, issued on December 18th, quietly raised margin requirements on silver forwards by 22%. That's not a routine adjustment, that's a liquidity warning. That's the exchange telling you, we see the pressure building and we're preparing for a gamma flip. The LBMA Good Delivery List currently shows 87 accredited refiners. Conversations with Tier 1 logistics partners indicate that 73 of those refiners are running 4 6-week backlogs on new orders. The remaining 14 are quoting premiums between $4.50 and $7.20 per ounce over spot for immediate delivery on quantities above 100,000 ounces. That's not a functioning market. That's a liquidity cascade in slow motion. The geopolitical fracture. Two prices, two realities. 8E1430. Now let's talk about the arbitrage that no longer exists. In a rational market, when silver trades at $29.87 in New York, it should trade at roughly the same price, adjusted for currency and transport costs, in Shanghai, London, and Mumbai. That's how commodity markets are supposed to work. Price discovery flows. Arbitrage opportunities get crushed within seconds by algorithmic traders. Except that's not happening anymore. Right now, as of this morning, the Shanghai Gold Exchange is showing physical silver premiums of $6.80 per ounce over COMEX spot. The Shanghai premium has been elevated for 11 consecutive weeks, the longest sustained divergence since the exchange began publishing data in 2016. In Mumbai, where India's jewelry and industrial sectors consume roughly 190 million ounces annually, premiums are sitting at $5.30 per ounce. In Dubai, the gateway for Middle Eastern and African physical flows, premiums are at $4.95. London. The LBMA is showing tightness in the forward curve, with 3-month lease rates spiking to 1.87%, the highest since March 2023. This is what a fractured market looks like. Paper trades at $29.87 in the derivative casino. Physical trades at $35.37 in the real economy. And the gap is widening. Why? Because the East stopped trusting Western paper promises. China has been on a multi-year campaign to de-dollarize commodity settlement. The Shanghai International Energy Exchange now settles oil in yuan. The Moscow Exchange offers gold contracts in rubles. And quietly, behind the scenes, China's State Administration for Market Regulation has been building a strategic silver reserve, estimated at 1.2 billion ounces as of Q3 2024, specifically to insulate domestic manufacturers from Western supply shocks. When Tesla calls a refiner in Switzerland asking for 50 million ounces, that refiner doesn't just check inventory. They check where the metal is actually located, because if it's in a London vault with claims tied to COMEX contracts, and if China decides to invoke force majeure on an export shipment citing national security concerns under the 2023 Critical Minerals Export Control Law, that metal isn't moving. And this is the nightmare scenario playing out in procurement offices across the industrial complex. You can own the paper, you can own the contract, but if you can't take physical delivery, you own nothing. Tesla knows this. Apple knows this. Nvidia knows this. Every company that watched the nickel short squeeze in March 2022, when London Metal Exchange prices hit $100,000 per ton before the exchange literally cancelled trades and shut down the market, knows this. That's why the smart money isn't bidding on COMEX. They're calling refiners directly. They're negotiating locked-in supply agreements with 18-24-month delivery schedules. They're paying premiums that would make your head spin, because in a stock-out scenario, there is no premium too high. The paper price is an illusion. The physical price is reality, and reality is about to become very, very expensive. Let's shift gears for a moment, because understanding the mechanics of the squeeze is one thing. Having the discipline to act on it is something else entirely. Volatility is not chaos. Volatility is truth in motion. It's the market shedding its lies and revealing the underlying structure of supply and demand, stripped of sentiment and narrative. Right now, the silver market is entering what I call a pressure chamber. The weak hands, the traders riding momentum, the speculators chasing quick flips, the institutions overexposed to paper derivatives with no delivery infrastructure, they're about to get crushed. But the disciplined builders? The ones who understand that industrial inelasticity creates non-negotiable demand. The ones who've been quietly accumulating physical at $26, $27, $28, while everyone else was distracted by meme stocks and crypto pumps. They're about to be rewarded in ways that will redefine generational wealth. Here's the philosophy you need to internalize. The market is a mirror of your character. When silver drops 8% in a single session because a hedge fund liquidates a leveraged position, do you panic? Or do you recognize that industrial demand did not evaporate, it intensified, and that the paper sell-off just created a buying opportunity at a price that won't exist in 6 months. Discipline is a superpower in a market where 90% of participants are driven by fear and greed. Tesla's procurement team isn't checking sentiment indicators. They're not reading analyst reports. They're looking at one thing: can we secure physical delivery or not? That's the only question that matters when your production line requires 2.8 ounces of silver per vehicle and stopping the line costs you $10.8 million per hour. This is the separation point, the moment where the gamblers get flushed out and the builders step into the vacuum. You want to know what conviction looks like? It looks like locking in supply agreements at premiums that seem insane today, but will look like genius in 18 months when the spot price catches up to the physical reality. Now let's talk about timing, because this is where the urgency becomes surgical. On January 15, 2025, the European Union's Critical Raw Materials Act provisions take effect. Among other stipulations, the Act requires member states to maintain a 60-day strategic reserve of materials deemed critical to industrial sovereignty. Silver is on that list. That means every EU manufacturer with exposure to electronics, solar, or automotive is about to receive a regulatory mandate to stockpile. On February 1, 2025, China's revised export control law amendments become enforceable, granting Beijing unilateral authority to restrict exports of refined silver under national economic security. Justifications with zero notice period. On March 10, 2025, the COMEX March contract, currently holding open interest of 142,000 contracts representing 710 million ounces, reaches first notice day. If even 5% of that open interest stands for delivery, we're looking at a demand spike of 35.5 million ounces, hitting a registered inventory base of 326 million ounces that's already under pressure. Do the math. Tesla's 50 million ounces plus EU regulatory demand plus Chinese export restrictions plus COMEX delivery pressure. You're looking at a demand tsunami hitting a market that's structurally short by 180 million ounces annually even before any of this started. This is the slingshot. The market is being pulled back so far, compressed by paper manipulation, regulatory bottlenecks, and geopolitical fractures, that when it releases, the velocity is going to be catastrophic. And here's the part that separates the informed from the delusional. Institutional money hasn't even entered yet. Sovereign wealth funds, pension allocators, and family offices manage $38 trillion in assets. If even 0.5% of that capital decides to add a 2% silver allocation as an inflation hedge or industrial play, you're talking about $3.8 billion flowing into a market with a total above-ground investable inventory of roughly $30 billion. That's an elephant trying to squeeze through a keyhole. When that capital arrives, and it will, because fiscal dominance and currency debasement guarantee it, there won't be enough physical metal at any price to satisfy demand without dislocating the entire pricing structure. $50 silver, that's not the top, that's the floor once industrial inelasticity meets monetary panic. $75, that's where premiums stabilize after the first wave of institutional FOMO. $100, that's where we are when Tesla, Apple, and every solar panel manufacturer on Earth are bidding against sovereign governments for the same 1,055 tons of refined metal. And if you think that's hyperbole, go look at what happened to palladium in 2020. It hit $2,875 per ounce, not because investors loved it, but because automakers had no choice but to pay. Silver is 100x more essential to the energy transition than palladium ever was to catalytic converters. So here's where we are. Tesla needs 50 million ounces. The physical market can't deliver it without cannibalizing someone else's supply chain. COMEX inventories are at multi-year lows. Premiums are spiking across every major delivery hub. Regulatory lockdowns are 15 days away, and the paper price is still pretending this is business as usual. This is not a prediction. This is financial physics. Supply and demand don't negotiate. They don't care about sentiment or technical indicators or Fed jawboning. When a structural deficit collides with industrial inelasticity, price discovery becomes violent. The question isn't whether silver breaks $50, $75, or $100. The question is, are you positioned before the repricing or are you chasing it after the window closes? Stay disciplined. Watch the premiums, track the delivery delays. Monitor the Shanghai spread, because in the next 48 hours, the market is going to start pricing in a reality that the paper complex has been suppressing for 3 years. And when it does, the wealth transfer will be absolute. The crime scene is still warm, the evidence is all there, and the assassins are about to get caught. The only question is, which side of the trade are you on?